Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending October 7th, 2022. Appreciate y'all tuning in to this channel and liking and subscribing, as well as subscribing to our podcast, InvestTalk. Now, this week I'm going to title the video, Economy Slows and OPEC Shuns the West as Markets Hope for a Fed Pivot. It's a long one, but a lot going on this week. And per usual, I'm going to start off with some economic data and then pivot into the charts. So we started off the week with manufacturing PMI indices that came in at about 50.9, slightly above the neutral rate. 50 is flat. So what you see here is an economy, at least on the manufacturing side, that is stalling. It's not shrinking, but it is stalling. But most importantly, it's about the new orders came in negative under 50, so that is shrinking. So going forward, it's showing forward-looking that the manufacturing activity will shrink in the coming months. But most importantly is this manufacturing prices paid index. And that did tick down again to 51.7, which you can see here going back to the pre-pandemic, September in 2020, it was at 53.3. So all the inflation of manufactured goods being in such high demand over the beginning and middle parts of the pandemic, that's all reversed. And you're seeing that across the board. All the retailers are talking about it. Nike, it's something like 64% increase in inventory year over year. And just all of these manufacturers are choking on inventory because they were flying things over the top when the ports are backed up last holiday season, and that meant the first couple of quarters they had just too much inventory, and you're seeing that feed through to prices. They're just unloading things. So it's very important to kind of watch this. Now, it's not the most important part of the economy, but it is something to consider. Employment index, that did tick down to 48.7, also shrinking a bit for the, fourth time in the last 5 months. And then you had durable goods new orders that came in on Tuesday. That was slightly negative for the second quarter in a row. So those big ticket items, people are slowing down there. And then you have the jobs JOLTS data. So this is job openings, and that was down over 1 million jobs. Now, I did think it was overcounting it for some very technical reasons, but it's the first big sign that this is correcting in a big way, and that the labor market is weakening. And that's what the Fed wants. The Fed wants the economy to slow, and they want inflation to come down, and especially on the employment side. Now, the more important ISM figure came out on Wednesday as well, and that was the services PMI. Services are a much bigger part of the economy and more impactful when it comes to inflation. We'll get to that number in a bit. But the general PMI number came at 56.7, roughly flat, a tick down month over month, but still growing decently. So that was a bright spot for the economy as a whole. But most importantly was this: the prices paid index came down again to 68.7, and this has a pretty tight correlation with the CPI. So you're likely to see another deceleration in the CPI number next week. And that's going to be the big data point next week, is what happens with CPI. That'll be the big headline number, although professionals follow this number a little bit more closely, and that certainly came down. Now, it's not back to where we were pre-pandemic. That was at around the 60 level. We're at 68, so still there's some pressure on prices there. But this is something that is likely to feed into the CPI number next week. And if we get that to come down in a big way, I think that could spark a market rally, but we'll talk about that in a bit. Now, the employment index, that one ticked up a little bit. So in this economy, more people getting jobs in the service sector than the manufacturing sector. Let's just say that. Now, initial jobless claims, that did tick up on Thursday to, that was decelerating pretty dramatically, and that came in much higher than we've seen in the past few weeks. And if you look at continuing claims for unemployment insurance, that one ticked up a bit, but we're not back above the 1.5 million. And when we get back above there, that's when I really think the labor market is weakening dramatically. Non-farm payrolls came out on Friday, a bit better than what everyone was expecting, and that caused the market sell-off, but still 263,000 jobs, not really that great of a number. So I didn't really think it was a great jobs report. But ultimately, the market has priced back a 75 basis point hike from in November. And last week when I did this video, it was closer to 50-50. Here's where it was last week. And now we're back up to 81.20. Remember, typically the Fed does, the market's priced in. And when you're over 80%, that's pretty much priced in. Now going out to February, last week was roughly 50-50 as well. But now we've ticked up a bit higher. So, continually strong expectations for rate hikes over the next few months. But we're still a ways away, so we'll see what the economic data tells us, especially that CPI number next week. So that was the economic data, and now let's pivot over to the charts. Now here's the S&P down over 100 points today. Reversed most of the gains for the week. Still up on the week, right? We closed really on the lows last week, so still was a positive week, but the last 2 days, Thursday, Friday, certainly dampened a lot of the bullish action that happened early in the week. Now, IWM to the SPY, that one continues to outperform. So you're really seeing the drop in the large caps more than the small caps. And that's natural. The spread in valuation between large caps and small caps is near record high. So much better opportunities in this market in the small cap space versus the large cap space. Now growth to value, that also continued kind of its rollover as rates remained relatively elevated. So continue to think this is more of a longer term trend. You're going to get those counter trend rallies in growth over value, but something to watch. And ARC, did we go to new lows? No, not quite new lows, but flirting with it there. Now the VIX, that did make a lower high this week, which was kind of a good sign. We didn't break out to new highs, and we're at levels that over the past year or so has marked at least a short-term bottom. That's typically what this is good for. And sentiment indicators are also showing that we should make a short-term bottom, maybe into December rally potentially in the Christmas and New Year's. But ultimately, this is something that you want the VIX to come down, and that will calm markets. And sentiment, like I said, did get kind of offsides last week. Let's touch on the 10-year. The 10-year, once again, had a pullback last week, end of last week, and into the early part of this week, but did get some resurgence on that strong services PMI data and then the jobs number today, but didn't break out. So, is it hitting some resistance here? We shall see. And more importantly, it's the dollar, right? The dollar, rising rates are less important at this point than I think the strong dollar that's kind of breaking things around the world. We talked about the UK and Japan last week, and that did get a nice rally. But once again, the CPI number next week will be important to see how that moves. What's kind of sniffing out to me the potential for a Fed pivot is gold and silver. You had a pullback today, but had a very, very strong week. Big up day on Monday, follow through on Tuesday, consolidation on Wednesday and Thursday, even though Thursday was a down day for equities. Had a strong pullback or a decent pullback today, but not really anything dramatic if you consider the recent move. And if you go silver, let's just look at silver itself. That had that breakout back in late July, consolidated, had the pullback, made it a lower low. But look at the MACD divergence here on 3 consecutive lower lows, and you had 3 consecutive higher lows in the MACD. And now the MACD is above the 0 line. That typically is an uptrend indicator, and we're above the 100-day moving average. So, you're getting a similar look on gold, but even more strength on silver. See, gold's not quite above that 0 line. But if you go with the silver to gold ratio, which is right here, that one's threatening the 100-day moving average. And look how strong that MACD is, well above the 0 line. You want silver to be in an uptrend in the precious metal space. So to me, this is kind of sniffing out a potential Fed pivot. Now, on the big news was really on OPEC this week. OPEC decided to cut 2 million barrels. Now, a lot of it was optics. They were already producing about 6 million barrels below their quota. Because frankly, I don't think they have a lot of spare capacity. Saudi Arabia does, maybe the Qatar, but not very many countries actually have spare capacity, and a lot of them are producing under their ability or their quota. And so, is this 2 million cut simply optics? I think potentially. Now, longer term, still think oil is going higher, but you did get a nice move higher in XLE. Probably not going to be a big move near term, but I think it was certainly of note that oil did have a nice reversal. And here's UNG. That was USO. Excuse me. Here's UNG looking to find support here at the 200-day moving average, and then commodities in general. Here's DBC that try to make a low, and look at this divergence here. Right, you had this lower low once again, but the MACD did not confirm that, and you're getting that reversal in commodities in general. So, the Fed can't print commodities, but they can keep the financial system kind of intact. And as I talked about on the show earlier this week, I don't think they're going to push the big red button. I think they're going to pause probably by year end, and they're looking for data to probably back that up, mainly on the inflation front. And next week, once again, will be a big week for that because of the CPI. But other data is showing that the economy is slowing enough for them to pause. Remember, monetary policy takes 6, 9, often 12 months to really feed into the economy as a whole. Just think of the housing market now and what you're seeing, prices finally falling, and that's mortgage rates were going up in the first and second quarter pretty dramatically. I know they've gone up even more in the third quarter, but the housing market hasn't quite felt that, and the economy hasn't quite felt all that. So you look at forward-looking data points, and it's clear that the Fed should probably lay off the gas a little bit, and I think they just need a little confirmation from the inflation index. So we're going to get that next week. I still think we're attempting to form at least a near-term bottom. Do we ultimately go lower in the first quarter? I think that's possible, but I do think you get some sort of rally. 4,000 to 4,200 is kind of what we're expecting into year end. Do we roll over before year end or after year end? TBD. Are we going to make a lower low? TBD, right? Maybe we make a higher low on the Fed pause, and you get more liquidity, because this is really all about liquidity drying up within the system, and the Fed can turn that tap back on whenever it wants. It's just more about political will. So we'll see what that looks like, and we'll see about that CPI data that comes out on Wednesday next week. Well, I appreciate you all tuning in. I hope this gave you some insights, and I want to remind you that the contents of this video are for educational purposes only, should not be construed as a recommendation to buy or sell a security or to participate in an investment strategy. The views are my own and do not represent those of KPP Financial or those associated. I appreciate you all. Have a wonderful weekend.